As you'll notice in the top left-hand corner, over here, I recently met with 3 people in the last week that said they have $200,000 they want to invest in real estate. So I said, here, let me break down a few examples that I would consider if I was them. So this investor has $200,000 to invest, if you'll notice everything in red. I gave them the example of buying 5 turnkey properties. A turnkey rental is a property that's already been fixed up by another investor. They're not going to need to put improvements in for 5 to 10 years as long as they manage it correctly, and it's got a good cash-on-cash return. In this example, they're buying 5 properties, 3 of them for $140,000, so 140, 140, 140, and then 2 for $155,000. Underneath that, they're putting 20% down. For the sake of math, we're keeping the numbers round. $30,000, $30,000, $30,000, and then on their 4th and 5th property, they're putting down $40,000 because they need to put 75% down. As they move forward in this example, for the sake of example, we're going to say that rents are all $1,200 a month, which at a 5% interest rate on $110,000 for the sake of math is a payment of $740 with principal, interest, taxes, and insurance. They're going to cash flow $460 a month times 12 months out of the year is $5,400. Now I know this doesn't take into consideration property management expense or deferred maintenance or inexperience of investing. Let's consider you are a really good investor and you manage them yourself for the sake of this example. So if they cash flow $5,400 a month times 5 rental properties is $27,000 annually. Obviously there's a lot of moving parts. But if they take the $200,000, I factored in $30,000 of improvements that they're going to do anyway because they still have extra capital. But if they take $27,000 divided by $200,000, it's a cash-on-cash return of 13.5%, which is great. So what I wanted to show, why would you want to do this? You have some tax benefits, you have depreciation also, you have appreciation of the asset, and you have some immediate cash flow. In sharing this, knowing that I've been investing now 10 years this year, I wanted to forecast or assume or give explanations of what would happen in 10 years. So, if we followed inflation at a 3% appreciation, these 3 properties we bought for $144,000 would be worth $188,000 each. The 2 properties that we buy for $155,000 are worth $208,000 each. That's a total value of $980,000. Now, what I wanted to share at the bottom is in 10 years, these payments will be paid down principal on 30-year fixed. The 3 properties we bought for $140,000, the principal balance is $91,000, excuse me. The 2 properties we bought for $155,000 is $95,000. So the mortgage balances, if they didn't sell or refinance, would be $463,000. The reason why I'm sharing this with you is I'm showing an example. If you invest $200,000 now in real estate, based on this example, your net worth would increase $520,000, which is awesome. Now, one thing that we need to take into consideration, we don't know what our taxes will be, we don't know what opportunity costs are. We also wanted to go over cash flow. If we're cash flowing $27,000 a year now, and rents increase 3% a year, in 10 years, our cash flow would increase to $36,000 annually. If our initial investment is $200,000, we'd make 18%.